So let's begin with the US market outlook. And let me start off with the macro picture, the big picture. So the US is currently entering a record 11th year of economic expansion. The expansion started in 2009, and right now, 2019 is over. It's been 11 years of economic growth. And the Federal Reserve, has reversed from rate hikes to now rate cuts. So again, the Fed has been raising interest rates for the last 5 years because of the recovery, but recently because of the trade war and some slowing growth in China and the US, they have started to cut interest rates temporarily. And I don't see them raising rates or doing anything like that before the election. So I see them holding rates or even cutting a bit more for 2020. Now this year, earnings growth for the S&P 500 companies are expected to be a lot higher than last year. So last year was really low, 0.9% growth. This year, earnings growth is expected to be 9.6%, which is above the 10-year average of 9.1%. So all sectors are expected to show earnings growth. Specifically, double-digit growth is expected from the energy sector. Simply because energy has been in a recession for a long time, the earnings are terrible, many companies are losing money, so they expect there to be a turnaround in the energy sector, as well as industrials and material sectors. So that's where most of the recovery is coming from. If you look at this chart over here, you can see that not just the US, but we expect global real GDP growth to start in 2020 after a small dip back in 2019. We think that it's bottomed out and it's going to start to grow again. So that's the bullish economic news. Okay, now to me that's not the most important thing. The most important thing in investing again is picking very good businesses, very good companies, right, that have got a wide economic moats. And those of you who have taken my value momentum investing course, you know exactly what are the best companies. But we only buy the companies when they are undervalued. The only way to make money is to buy when it's selling below the intrinsic value. Now, right now in the US, most stocks, most companies are not cheap anymore. All right, prices have gone up quite a bit, so that share prices are now currently slightly at or above its fair intrinsic value. Now, if you look at overall the S&P 500, the PE ratio of the S&P is now 21.59, somewhere about here, this level here, 21.59. This is the current PE ratio. Now, you can see that for the last 60, 70 years, you can see the PE ratio goes as low as about 5, as high as about 30. So basically, the average PE ratio for the last since 1954 has been about 16.56. That's the average PE ratio, which means anything above that is above fair value, expensive. Below that is undervalued, the overall market. So you can see that right now at 21.59, it is above 16.56, which means that, again, like I said, overall the US market is not cheap. Cheap is under this line. It is expensive, but I wouldn't say it's in bubble territory yet, which means it can still go higher, right? Because historically, the PE has gone as high as, again, 26 or even 30 before it bursts, right? So not cheap, expensive, but not overly expensive. Now, if you look at individual sectors, now energy, to me, the energy sector is still undervalued because it's been in a recession. Financials are a bit expensive right now. Consumer staples are expensive. Consumer discretionary is expensive. Technology, interesting enough, although technology has performed really well last year, 40% return, but I wouldn't say it's really expensive. It is still fairly valued, right? In fact, if you take a look at some of the intrinsic valuations, those of you who have taken my courses, you get these intrinsic value calculators, right? Which you can calculate the true value of the company based on its cash flow, of its debt and its assets. So for example, you can see Amazon, right? Currently the intrinsic value of Amazon is about $2,000 per share, right? And currently it is selling at, let's check it out, what's Amazon selling at right now, right? So Amazon is now selling at $1,800 per share. So Amazon is still undervalued, right? It's still below its value. So it's still a reasonable time to accumulate Amazon. Okay. If you look at Alphabet, or known as Google, okay, the intrinsic value is $1,400 intrinsic value, and the price of Alphabet is 1361. So again, it's slightly undervalued, right? So interestingly, technology companies are still undervalued, except for, of course, Microsoft. That's really expensive, and Apple is also really expensive. But many of the companies I'm holding are still fairly valued. How about Facebook? Fine, let's look at Facebook. Facebook's intrinsic value is $263 per share, right? And currently it's selling at $210 per share. So Facebook is still relatively quite undervalued, right? So besides looking at company fundamentals, I like to look at the charts to know the overall trend of the market. Are we on an uptrend or downtrend or consolidating, right? So if you look at the S&P 500, okay, there we go. So right now you can see we are on a very, very clear uptrend. And I always say the trend is your friend. Follow the trend. Never attempt to predict or outsmart the market. Just follow the market. As long as the market's on an uptrend, you keep going long, you keep buying, you keep being bullish. When the market reverses into a downtrend, right, you can get out, you can short the market, you can hedge your positions. It has not happened yet, right? So currently you can see very nice uptrend, right? Prices are making higher highs, okay, higher highs, and making higher lows, okay? Moving averages are sloping upwards, indication of a strong uptrend. But having said that, it's on an uptrend, but it is right now at the top of the uptrend. Remember that prices move in wave patterns, breathing patterns, right? So it doesn't go up in a straight line, right? It goes up, breathe out. It can't breathe out forever. It has to breathe in, and then breathe out, breathe in, breathe out, breathe in. All right, so market prices are made up of impulsive, we call this the impulsive wave, and corrective wave. Okay, so if you take a look at these wave patterns, breathe out, breathe in, breathe out, breathe in, breathe out, breathe in, breathe out. Okay, so you can see right now we are here, we are at breathing out towards the end. Now, it's very hard to tell exactly where's the top, right? But you know that eventually it can't breathe out forever. It will eventually have to come back down again to one of the moving averages, maybe the 150 moving average or 200 moving average. And once it comes back down, that's when I'll start adding more shares. That's when I'll get in again to the market. So will I buy over here? I won't buy. Never buy near the top, because the moment you buy, you will tend to retrace, wait for retracement before getting in again. So that is true for the overall market, true for individual companies. So if you look at, for example, Facebook, okay, so you can see Facebook's on an uptrend over here, okay, and although it is undervalued based on fundamentals, but would I add over here? No, I won't, right? Because you can see this wave up, wave down, wave up, wave down, wave up, okay. So I want it to come back down somewhere about here at about maybe 188. Before I start buying again to catch the next wave up. So you always want to buy the dip on the uptrend, never buy the high on the uptrend, never chase it once it's moved off. Okay, and you can also look at, for example, the weekly charts, weekly candles to give you some perspective as well. You can see a strong support over here. So it's wave up, wave down, wave up, wave down, wave up. I wait for wave down before accumulating shares over there. Okay, so like I said, in general, stocks are fairly valued, a bit overvalued, but there are a couple of technology companies that are still cheap. All right, like Facebook, Alphabet, and Amazon. Like Apple is really expensive right now, So I would definitely not buy Apple right now. You can see Apple has been on a tear. Look at that. All the way up. My God, right? Now, eventually, it's not going to go up forever. It has to come back down to about... So I'm going to wait for it to come back down to about 198 to start buying Apple again, right? And after I buy it, then I will wait for the next wave up again, right? So always be patient, never chase a stock. And of course, there are some stocks that I went into and they have not recovered yet, because I like to buy stocks that have been hit by bad news. And sometimes it may take months or even a couple of years to recover. So what has not recovered yet is Boeing, right? So I'm in Boeing, and you can see Boeing has been having problem after problem after problem, right? So it's been consolidating in kind of like this trend where there's a strong support level here, support, and there's kind of like a resistance level over there. Now Boeing, there's only one competitor, which is Airbus, right? So eventually Boeing will sort out its problems. Eventually it will go to $450, $500, $600. When will it happen? I've got no idea, right? But the thing is, I make money by buying it when no one wants it. So right now at a support level, right, it is not a bad time to accumulate shares, to buy shares at this level, right? Of course, it could go lower, and if it goes lower, I'll just buy more. But I know that eventually, if I start accumulating at support levels, and consolidation is going to eventually break out to a new high. So Boeing, I'm still holding steady. I've made everything, money on everything. Boeing, not yet. Boeing still going sideways over there. So in summary, for the US market technicals, stocks are on a very clear uptrend, but they are right now at the top of the uptrend at overbought levels. Many indicators are overbought. So I do expect a healthy correction soon, maybe 5, 10, 15% correction down back to the moving averages before prices are cheap again, and that's when I'll start buying again. Remember, what goes up must come down before going higher. So my overall overview and strategy of US markets is this. This year, all right, as long as the trend remains up, which I think it will, I still expect positive returns from the US markets, but I expect lower returns in 2020 compared to 2019, right? Because 2019 we were up almost 29%, so it's not realistic to think that you're going to get another 29% in 2020, right? I doubt it, right? So in 2020 I expect maybe 5, 6, 7% returns from the overall market, right? I expect a correction back to the moving averages, like I mentioned. So in anticipation of a healthy correction, I've used what I call some hedging strategies. I use options. So I highly recommend you learn options. You can take our basic and advanced options course to learn how to protect your portfolio, so that when the market comes down, the options will generate profits to offset the temporary drop in your portfolio value, right? So I use many option strategies, which are called bearish option strategies, like I go long on the VIX, which is the fear index. I use what is known as a bearish Snipex calendar spread. And you can't read this anywhere because it was invented by my partner, Bang Pham Van, and is taught exclusively to our options students. At the same time, I also sell covered call options on my stocks to generate extra income in anticipation that the stocks will go sideways or go down. So even if the market goes sideways for the whole year, market goes down, I'm still earning premium every month by selling covered call options. And the premiums I get are about 2% a month. May not seem like a lot, but 2% a month is 24% return a year. So even if the market goes nowhere this year, I make 24% return. All right. So right now, I don't have much to buy at current levels because I think things are a bit expensive. So I'm waiting for the market to correct, to go down at least, at least 10, 15, or even 20% before I start buying again. Because I like to buy undervalued. I like to buy when it's cheap. I like to buy when there's bad news. So I'm waiting for the next bad news, the market to panic, people to dump their shares. I'm going to buy, and that's the time to buy, right? So don't buy when it's good news, buy when it's bad news, right? And if you look at this interesting statistics, let me show you this, all right? So you can see that most of the time, markets end up the US market ends up going up, right? So how often does the market go up between 0 to 10%? Pretty often, right? 10 to 20%, very often as well. 20 to 30% is the most common, in fact. So in fact, again, last year, 2019, we clocked a year where the markets were up 20, 30%. Okay, but again, I don't expect this to happen this year, right? So again, well, you never know, right? Markets could go up slightly less, right? Now, could the markets go up 30 to 40%? Happens, but not as common, right? 40 to 50%, 50 to 60%, very, very rare, right? But it has happened in the past, not for a couple of decades, in fact, right? And again, markets could drop, and there is a pretty good chance over here markets could drop 10%. And it's good news when markets drop 10%. There's a healthy correction to buy more, right? To buy more before it goes. Remember, what goes down will always go up, provided you buy fundamentally good companies that have passed our screening process, all right? And you can see that during market recessions, markets can drop 10 to 20%, 20 to 30%, 40 to 30%, or even drop 50%, right? But again, these are very rare. It only happened 3 times in about, how many years is that? Since 1920, it's about 90 years, right? So only in 3 years out of 90 years has the market dropped more than 30%, right? So it's really, really rare that happens, okay? Most of the time, market will drop 10 to 20%, 20 to 30%, even that's quite rare, right? Most of the time it goes up. All right, so if you have been following me for some time and you have been investing in good companies like me, you may find that, hey, right now you've made a lot of profits, you're sitting on a lot of unrealized profits, your stocks are really high, and you think, hey, a correction is going to happen eventually, what do I do, right? I don't want to see, the money I made disappear, right? So a common question people ask would be, what do I do when my portfolio is overvalued? What can I do? Well, here are a few options. Number one, don't care about it. Simply close your eyes and hold it through the ups and downs, all right? And eventually when the correction happens, when the market drops, 5, 10, 15%, get excited and buy more shares, right? If it's a good company, buy more shares at a discount, right? Because you know that eventually it's going to go higher anyway. So what's the worry? But of course, you have to be psychologically prepared for a temporary drawdown on your portfolio. You have to be temporarily prepared to see the value of your portfolio go down and be okay with it. Because you know that, hey, it's going to go up higher eventually, right? So, for example, if you take a look at a great company, look at Microsoft, for example. Now, this is Microsoft for the last 5 years, the 5-year chart, right? And 5 years ago, Microsoft was at $40 per share. Now it's $160 per share, okay? So think about it, right? Now, if I were to zoom back in history, let's go back 5 years ago at about this time, right? And say you bought Microsoft here at about, $34. You bought at $34, it went up to 42, and you say, hey, I'm pretty happy, right? I made some money, right? And then what happened? It came down again, and you say, oh, darn it, right? You get upset, and right, lost all that money, right? But why worry? If it's a good company, you know that it's going to go up, right? You've done your fundamental research. It's a good business, right? And eventually it's going to go up from 34 pounds, now it's going up to $50, okay? And again, at 50 bucks, it drops again to 42, you get down, it dropped again, right? And you get all upset. But why get upset, right? Think about it. If you just held the darn thing for 5 years, okay, from $40, it's now at $160. So these temporary ups and downs are things that you should ignore, right? Psychologically get over it, Okay, it's like, you marry someone, there's a good person. In the short term, they're in a bad mood, they shout at you, they go nuts. Just smile and say, I love you, dear, because eventually they're gonna get over it. Eventually it's gonna go higher, right? But if you get upset, you get depressed, you take it personally, you fight back, you shout at them, and that's what breaks up a relationship and a marriage. That could be wonderful, right? I've been married to the same person now for this is our 20th anniversary, and I've been with my wife for 7 years before we got married, right? For 27 years we've been married, okay? And a lot of people ask me, what's the secret of a lasting marriage? And the answer is this, right? You're gonna have quarrels, you're gonna have problems. You can't take it personally. When they get nuts, when they start getting a bad mood, just smile and say, I love you, right? Just know they're a good person. As long as they're a good person, you know that you're gonna get over it, right? Whatever short-term problems is gonna go higher. Same thing in the markets, okay? Now, of course, that's option one, which is the simplest option. Just buy, close your eyes, and make the big money in the long run. Don't get caught up in a short-term temporary drops in the share price. Okay, now is there an option two? Now, option two appeals to a lot of people, right? Sounds good, option two, which is, what's option two? Which is attempt to sell your shares at the high, get out, and attempt to buy it back when it drops lower, nearer the moving averages. Now, of course, this sounds fantastic, sounds great, but it's not always easy, especially if you don't watch the market every single day, all right? So it's not always easy to time the selling of the exact top and buying back of the exact bottom. And the risk of option two is that you may sell your shares at what you think is a high price, and the moment you sell it, guess what? It goes even higher, and you miss the rest of the ride, right? Or you sell it, it goes higher, and when it drops, you think it's going to drop some more, and you're waiting for it to drop some more. It doesn't drop, it keeps going up, and you miss it. And you may have made that $30 to $50, you may have made $20 and be really happy, but you missed the $50 to $160 move in the markets, right? Happens to many, many people, all right? So for me, are there times I'll sell a share when it's really high? Yes, I will, if I need the cash. So if I need the cash, then I'll sell the shares, I'll take the cash, and I'll immediately use the cash and redeploy into the market, into another very good company which is undervalued. That's fine. But if I don't need the cash, if I don't need the money, I just leave it there, right? Just let it run, right? Now, my favorite option is option 3. Now, before I talk about option 3, let me share with you an interesting statistic, which is what happens to most retail investors. Now, most retail investors, they don't know how to read charts. They don't know how to time the markets well with technical analysis. So the moment they make a bid, they sell, right? And they miss the big run, right? Or it drops, they don't buy it back. They think it's going to drop some more, and it goes up, they miss the run again. And they attempt to time the markets very inaccurately, okay? And timing the market for most people can be extremely costly, all right? Now, if you take a look at this chart from 1959 to where we are roughly today, you can see that this is the buy and hold strategy, which means you just buy and you close your eyes through the ups and downs, you would have gotten this result over here. But most people who attempt to get in and out of the markets, right, not successfully, right, what happens? In that same period, they only end up here. Now, that's a big difference. Starting with $100, the person who just bought and held and closed their eyes would have gotten, you can see somewhere here, which is about 50 grand for $100. But the person who attempted to get in and out ineffectively would have ended up only here at less than $1,000. So attempting to time the market ineffectively can be extremely costly for the long-term build-up of your wealth and your portfolio, right? So what do? I don't do option 1, I don't do option 2, I do option 3. Oh, but before that, again, let me give a quote, or let me quote this guy, Peter Lynch, one of the greatest investors of our time, and he said, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. Think about it. It's deep, but it makes sense. Okay, so what's option 3? What's my favorite approach in the market? So When I buy shares and the shares go up and it's overvalued, I'm making a lot of money, I don't sell the shares unless I need the cash. But what I do is this, I hold on to my shares, but I sell covered call options. I sell options, covered call options on the shares to collect income, to generate monthly income of about 2% a month, about 24% return a year. So even if the stocks, again, they go sideways or go down, I still lock in 24% return a year, fixed income from selling covered calls. At the same time, I use put options. Now, put options are kind of like insurance policies. Like in Australia, it's really sad. Now they've got all the bushfires. So if you own a house in Australia and it's worth $1 million and the fire's coming to your house, what do you want to do? Right? You can't sell your house and buy it back. It's tough, but you can buy fire insurance. So, but you pay a premium, you buy fire insurance. If the fire burns your house down, what happens? The insurance company pays you for the house value that you lost, right? You know, it's a great thing. You can do the same thing in the stock market using put options. Put options are insurance you buy on your portfolio, okay? So I use protective put options, protective put spreads, and an advanced strategy known as snipebacks to hedge my portfolio. So now that my shares are very overvalued, I use this strategy. As you can see, this is my portfolio over here, right? And you can see that I've got all these what we call calendar spreads, which are advanced option strategies. So even on the day when the market went down on the 30th of December, you can see that my account did not go down. It went up slightly in value. Why? Because all these put options generated profits overall to hedge my short-term loss in my investment portfolio. So I highly recommend you learn options. If not from me, learn it from someone else. But I think I'm the best. Together with Bang Fan Van, who's an options genius, right? We've got our basic advanced option course. Take the course. You can do it online from anywhere in the world or see us live in Singapore. When you learn these strategies, you get to protect your portfolio during up and down markets. So you get the best of both worlds. You get to keep your shares. So if it goes up, you still get to earn on your shares, but you get to protect your profits at the same time, right? So it's something that is really great to learn. So what could cause the markets to correct in 2020? Like I said, I expect the market to go down, to correct. It's only healthy and natural, and that's when we buy shares at discounted prices. So there are two events I'm watching. The first major event for the year, of course, is the ongoing trade war. Now, recently there's been a bit of a phase one deal between the US and China, but don't expect it to last. You know, it's only a matter of time. Things are going to flare up again. The Chinese are going to not do certain things. Trump's going to tweet and the thing's going to blow up again, right? So expect that to happen. But when that happens, I love it because that means that the market gets volatile again, and volatility is the friend of the investor because volatility allows us to buy shares when people are panicking and selling them at a ridiculous price. So when the trade war erupts again, what are the sectors or industries that are likely to get affected, right? So sectors most affected would be semiconductor industry, electronic manufacturers, okay? But the thing is, I don't really invest in those industries because they're very price competitive, right? So it doesn't really affect me anyway. It will affect retailers, right? Like Bed Bath & Beyond, Dollar Tree, and Abercrombie & Fitch. Again, I'm not really into those retailers as well. These are specialty retailers. Although I am looking at Lululemon to take a position in that particular company. So hopefully the trade war could get me a good price on that, all right? It also affects sectors like auto manufacturers, agriculture, and materials. So personally for me, for those of you who have been following me, you know that I avoid all these sectors because I don't like sectors that are price competitive, that don't have a strong competitive advantage, all right? And again, very affected by the global war, trade war. So I tend to avoid these ones. But the other main event I'm looking at, of course, is the US presidential elections. which is coming up on the 3rd of November, where Donald Trump will face off probably another Democrat, right? So this will have huge implications on taxation and industry regulations. So if Democrats were to win the White House and Congress, all right, and they control most of the government, especially if the Democrat is a very left-leaning Democrat, like Elizabeth Warren or maybe Bernie Sanders, and they are quite anti-business, right? They want to break up the banks. They want to end private health insurance. They want to break up the technology companies. Their win, or could spark a sell-off in technology companies, in healthcare companies, in financials, as well as energy companies. Okay, but I will use that opportunity to buy my favorite companies at huge discounts. Okay, reason is because even if they do win, it's very hard for them to pass through legislation to actually break up the banks, to break up the tech companies, to end private health insurance. So a lot of this is emotional, psychological panic that causes people to sell the shares. But very often, it takes decades to execute the policies, or many of them will not even be executed anyway. All right. So I look forward to the elections, and I look forward to the volatility that will happen that may give me the chance to buy, again, my great companies at big discounts. So that's basically my outlook for the US part of the markets. So if you want to be the first to get my next video on YouTube, do click the subscribe button right now. If you want to check out my online courses, go on to piranhaprofits.com, where you can enroll in our professional Forex, stock trading, options trading, and value momentum investing courses, where you're going to learn how to trade like a professional and generate an income anywhere in the world. If you would like to come to Singapore to attend my live classes, Wealth Academy, go on to wealthacademyglobal.com. It's Adam Khoo, and may the markets be with you.